Hello and welcome. We are absolutely delighted that so many people from around the world can join us today. We should be well over 200 in attendance, with people from many different areas of the investment industry, and indeed a few, I think, from outside it as well. You are all very welcome. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in the City of London, but we do spend quite a lot of time in the States as well, and that's where I am today. One of our 4 monthly publications is the ESG report, which focuses on investor allocations in sustainability sectors and also the impact of ESG on the fund industry, both the alternative and mainstream sides of it. So joining me today, we have Marika Delling, who's principal at ESG and sustainability at MJ Hudson. MJ Hudson has a number of products for investors and asset managers, which I was just saying, primarily on the private equity side to help them with their ESG strategy. We have Patricia Pina, who's head of product research and innovation at Clarity AI. She specializes in measuring sustainability and impact in order to help financial stakeholders implement sustainable investment strategies. We have Bob Swarrock, who is principal of Candor Global Advisors. He is an expert on risk, and he advises institutional investors in a number of areas, particularly on their ESG strategies, but in other areas too. He also sits on numerous industry and investment boards. And we have Karina Vaughan, sales director at GHGSat, which is a leader in remote sensing of greenhouse gas emissions for industrial sectors. GHGSat delivers emission data on carbon-intensive energy costs. Now, I'm going to give a short presentation by way of introduction, and then we will get into a panel discussion with the panel. So the most important that there is, as I was telling the panel, sometimes this wretched presentation sticks on the screen, which it is doing right now. So I will carry on talking, and hopefully it will kick into life in a second. I think it's worth making the point by way of introduction today that when you step back and think of what's happened in the last few years, there has been quite an extraordinary growth in the whole phenomenon of emissions reduction investing, particularly in the last few years. It's grown out of the ESG movement, obviously, but it is now really taking off, and there will doubtless be much more innovation in the next few years. Larry Fink, as many of you will know, is the CEO of BlackRock, which is the largest asset manager in the world. He has taken, and BlackRock has taken the lead on ESG investing, and he has said climate risk is also investment risk. And it's not just the mainstream fund managers who are getting into this, very much the hedge funds are, and the private equity firms too. So you see across the board, managers from everywhere are much more focused on this than they have been ever before. It's also worth making the point that there are a number of particular industry initiatives out there at the moment. One is the Net Zero Managers Initiative, and also the most recent Global Investor Statement. Under the Net Zero Asset Managers Initiative, many major asset managers have signed on to convince companies that they invest in to achieve net zero emissions by 2050. And then the 2021 Global Investor Statement covers 733 investors with $52 trillion in assets, and with the staging point of 2030, they're trying to persuade the the companies they're investing in to get their emissions down to net zero, with a staging point of 2030 along the way to 2050. Since we don't have this presentation, let me carry on with the comments I wanted to make by way of introduction, which is there's a whole bunch of surveys that have been done on asset owners, which show implementation and interest in making sure that asset GHG reductions is taking place. EY's fifth survey in 2020 showed that the vast majority of those people they surveyed are into demanding from their investment schemes greenhouse gas reductions. And then in Morgan Stanley, which does the survey every 2 years, showed that there was something 80% of the people they surveyed are now, this is pension funds are very much into ensuring the greenhouse gas reductions are taken into account in their portfolio. And the research that we did at IFI Global last winter also showed that the majority of the pension funds we interviewed are very much also into making sure that they are investing in greenhouse gas reduction too. Divestment is still the biggest part of their ESG strategy. That's divesting from things that they are not wanting to touch, the things, you know, polluting industries or pre-Ukraine weapons reduction and so on and so forth. But those that have declared, these are the largest pension funds in the world, what they are investing in terms of their ESG carbon reduction strategy, greenhouse gas reduction is the easily the most popular. 97% of those that report it say that they are investing in greenhouse gas reduction strategies. So it's overwhelming evidence over the last few years that institutional investors, not just pension funds, but particularly institutional investors, are very focused upon this. Clearly, that is not going to go away. Another point to make about greenhouse gas reduction is the why do it other than for sustainable reasons. There are two reasons in particular. One is risk reduction, which we're going to get into in a minute with the panel, and the other one is performance. On risk reduction, of course, pension funds and other institutional investors are long-term investors. In the case of performance, there's ample evidence and growing evidence that firms that have a lower carbon footprint have a better return on operating capital employed. And doubtless that is going to continue into the future. So I'm now going to, apologies for the failure of my presentation to come up. I'm now going to stop sharing screen and come to the panel. At least that worked, thank goodness. And I will ask the various members on the panel to make some brief introductory comments before we get into the overall panel discussion. So Karina, would you like to go first?
Yes, thank you, Simon. Sorry to miss your presentation, but we will be sharing a copy of the report with everyone who registered for the seminar, so they'll get to see what was in the presentation anyway. So thank you, Simon, for the introduction. Delighted to join everyone today, and very pleased to offer some thoughts from GHGSAT's rather unique perspective of greenhouse gas emissions monitoring. So as the global leader for the satellite monitoring of industrial greenhouse gas emissions, GHGSAT is the only company in the world today that can provide high-resolution greenhouse gas measurements of industrial sources using its own constellation of satellites. We have 6 satellites in orbit today, with another 6 launching next year, monitoring hundreds of thousands of industrial facilities worldwide. So historically, to measure emissions, industry and governments have relied on bottom-up estimates using a mix of engineering calculations and emissions factors, subject to significant variations and with different interpretations of the data. Remote sensing using satellites and of course aircraft is now providing top-down measurement of emissions, both at a regional level and at a facility level. And interestingly, several peer-reviewed analyses over the last few years have demonstrated up to 2 times higher emissions as measured top-down versus bottom-up estimates. And so nobody will be surprised to hear that reconciling top-down versus bottom-up is currently the subject of intense effort in the emissions monitoring community. And this is of vital importance as we see the direct measurement of emissions transforming target setting, reporting, data preparation, and verification of other emissions data. And so in addition to helping companies to measure their emissions, we work with trustees of pension funds and with asset managers who are actively seeking to address gaps in existing climate-related data. And because of the very significant impact that methane has over the first 20 years after it reaches the atmosphere, the initial focus is on measuring and understanding methane emissions from investments in industrial sectors, including oil and gas. And not just to manage climate risk, but also to understand the financial risk of methane leaks, which are often relatively easy to fix once identified. And let me just spell that out for you in monetary terms. So in June, our constellation detected a small emission from an oil and gas facility in the Permian with a rate of 102 kilograms per hour. So if this leak had continued at the same rate, the product value lost is estimated at around $1,100 per day based on current wholesale natural gas prices. So by prioritizing methane reduction and measuring, tracking, and most importantly, advocating for the reduction of methane emissions in holdings, pension funds in particular can address both climate and financial risk and map out a clear path to rapidly affect the environmental footprint of portfolio holdings without having to divest from fossil fuels, because after all, the fund exists to provide for the retirement of its investors.
Okay, thank you. Can I ask everybody else if they'd like to make some brief opening comments before we get into the specifics? Bob, in terms of the whole panoply of what's happening in greenhouse gas reduction investing, where do you see overall the connection between investment risk and climate risk, if that's the right way of putting it?
So look, I think this is a very timely discussion because the simple truth of risk management is one rule is garbage in, garbage out, right? And I think we have to be very mindful of the fact that climate risk at the moment is an art, not a science. No matter what people may say, data quality sucks in general. And Karina, I'm not talking about your data here, but in general, it is pretty poor. And we see that across the board. And one of the challenges you have is that not because of the kind of sheer volume of regulation and kind of policy that has come up to wait on this topic, you have the most ridiculous number of people popping up, offering you everything under the sun. It's almost like the Wild West, where you got snake oil salesmen and the whole works, as it were, out there. That is a risk in itself. And that is probably the biggest risk I would highlight in climate risk for people today, which is you have spurious data, you take it, you put it in your portfolio, and you will end up with garbage in and garbage out. So climate risk and investment risk have to be integrated because otherwise there is absolutely no point in looking at it. Risk is a multidimensional surface and you cannot segregate into different flavors, right? You look at the risk of an investment in a very holistic way. You look at counterparty risk, credit risk, market risk, data risk, all sorts of things like that. And actually, if you look at ESG more broadly, and climate risk, of course, where most of that focus ends, you will find that people tend to have sort of three main concerns. The first usually tends to be around greenwashing of some sort, which is kind of scrutiny. The second actually is around transparency and quality of data. And the third tends to be around the ability to actually measure and to be able to kind of drive change in any meaningful way. So I think this is a very, very important topic, because if you're going to make this worthwhile, and I don't really care a toss about TCFD and stuff, because that's just somebody else trying to tell you what you should do. In reality, if you want to do it because you want to understand your risks, you want to do it properly. And that means thinking very, very hard about what the things you take in on. The other thing I would highlight is that risk is actually ultimately a judgment call. Risk is not something that is objective. It is you looking at your portfolio, your liabilities, and so on, and trying to understand the risks that apply to you. That means that, for example, your risks are very, very different. Climate risk is a big catch-all phrase. For example, an investor with a portfolio of, say, property assets in the States will have a very different climate risk profile to an investor who may have a similar portfolio, say, in Australia. The data quality also varies hugely. This is something, for example, that you will find that the insurance industry in its modeling of climate risk has seen repeatedly, which is that they just have far more data available on hurricanes and things like that, say in the States, in Florida, wind and San Fran and things like that, and much poorer quality data available, say, in Australia and New Zealand. So I think it's a very important part. The other bit I would also highlight is that there is a lot of data out there. So one of the other bits of risk that to think about is what is the relevant data that they want to pick out of that. Because I know that Karina is doing some good work in terms of thinking about how these things integrate into portfolios. And that will be very, very useful to try and understand exactly what the utility of that data is and where it fits in. And then people can actually rank this risk versus other risks and take a kind of more balanced decision. Because one of the mistakes I think people sometimes make is that, we do a lot of stuff on ESG. We do it from a governance point of view. We do it from trying to help people understand what's happening under the hood and also think about exactly how to integrate across their balance sheet. But people forget that ultimately the point of risk management is to drive decisions. And those decisions are not just about climate. Those decisions will be, for example, like if a pension fund is securing members' benefits. In the case of an insurance company, it is shareholder returns. In the case of an endowment, it may be the income stream they depend on to make their charitable sort of elements. These are different objectives. And climate risk comes into that in the same way investment risk does. And the way I would look at it is that investment risk is a combination of short to medium term risk, whereas climate risk becomes a medium to longer term risk and potentially an extra source of volatility in the nearer term that needs to be understood. So it's just bringing that in and thinking about where that fits in, which I think ultimately requires in the first instance data, as I said.
We're going to very much get into the whole question of data, because I think the point you've made very well is how much you can advance the whole investing process depends upon how much you can rely upon the data. We're absolutely going to be getting into that in a few minutes' time. Before we get to that, Marika, do you want to make some broad brush comments about the whole emission reduction investing trend and what do you see that's going on?
Yeah, of course. So maybe some perspective on my background is we support private equity investors and their portfolio companies on integrating ESG into their processes, which includes carbon reduction strategies. We have carbon and climate practice focusing on that. I think one point of view that I would like to add in this conversation is, yes, creating insights into the data and getting the right data is super important. And I completely agree with Bob's observation, garbage in, garbage out. But I would also like to take it like one level higher, which is in parallel to creating insights, we can already do a lot of stuff because we kind of know where the emissions are coming from, right? So, there's a couple of things that each company can start doing now. And instead of waiting for the emission data to come, out of one tool or machine, or I don't know. And I think that, we know that we need to be more efficient with the use of our energy. We know that we need to think about other types of energy sources. We know that buying a product that is produced in another continent might not be the best use of our resources. So I think that those are all considerations that we can already implement now. Each company can already start integrating that into their processes while they are also creating insights and making sure that what they are looking at is not garbage. But I would like to add that point of view in this discussion. Hopefully we will get into that later today.
Thank you. And Patricia, finally to you, have you got any broad comments before we get into the specific areas?
Yes, definitely. So thanks a lot, Simon, for the introduction, and a pleasure to be here today with all of you. So very quick, also as background, Clarity AI is a technology company. So we offer a sustainability technology platform. And I think from that perspective, a couple of things. So I fully agree with Bob. Data is the basis of everything. Inside, we have been talking about, well, asset managers, the role they have to play, the net zero, the asset manager net zero initiative. You were mentioning trillions of dollars, 60+ trillions of dollars, the role they have. They need data and they need insights for that. And that data is very challenging. And we will talk about the challenges, the coverage, the quality, the transparency, and hopefully we will dig into that. So what I want to bring in there is technology has a role to play. I think Arina was talking also about like alternative data sources complementing traditional data reported by the company. So definitely that's a piece. A piece is how can we leverage the technology to actually also assess the reliability of the data we are using. Also transparency, making sure like investors understand what data, what insights they are using, and whether the data is fit for purpose. That I think it goes back also to Bob's point about you need to understand what do you want to do, what are you trying to achieve, what is your objective, what do you need in order to do that, and what you have bought, what you are using, is it fit for purpose, yes or no? So those pieces are very important, and they need to be there in order for us to make progress. The other piece that we haven't mentioned is like the data or the analytics need to be available to the people they need it, when they need it, where they need it, because we have data, but I think also integrating relevant insight into existing workflows and processes is very important so that actually they can use that data for decision making. Bob was mentioning actually here we are trying to make decisions. So in order for that to happen, I think there is another piece about existing workflows and how do we make sure that these capabilities are available when they need it and are usable to the people that need to use them. So let me stop here, Simon.
Thank you. Before we go on, I forgot to mention at the beginning, we'll of course be delighted to take your questions. If you'd like to ask questions, just use the Q&A button, hopefully is there on the bottom of your screen. We may conceivably take one or two as we go along, but more likely we'll save a few minutes at the end for questions. Bob, can I come back to you to ask the following question? You've been obviously from a whole different variety of angles over the years and following various different aspects of the whole investment activity on the alternative and on the mainstream side. Am I right in saying that the whole climate change movement, if that's how you want to put it, is changing investing into a three-dimensional activity? So alongside the traditional risk and return trade-off, is there another dimension that's coming in that you have to, or particularly if I'm talking about the long-term investors such as the pension funds that you know well, are having to incorporate another dimension into their calculations? Is that the right or the wrong way of putting it?
Well, I was going to say, I think investing has always been a multidimensional activity. I think three dimensions limits it in some ways, because the problem is there's so many things to consider. And that's part of the reason why, as investors, people always struggle. And we're always looking for the perfect investment, the perfect manager, the perfect strategy, and so on. Climate, I think, brings in an additional dimension of risk, but I will point out that it actually brings it in two different ways. The first is that with climate change having become a big, big topic, there is a risk from an investment point of view that people may care about, such as the impact on their portfolio of various elements of climate change. And you have to identify those, and I think scenarios, etc., can help potentially, but even those can be quite vague. The second bit, which I don't think people think about as much, is actually what I would call business risk, operational risk, which comes in through climate change. And there I'm really talking about the fact that I'm talking about the rise of climate litigation, which is a huge growing trend, in particular in the US, the home of litigation, as it were, but the spiritual home of litigation at least. But the point is, it's a huge growing trend. And that is something people don't realize, which is the bigger risk you probably have in your portfolio is not if your thing's going to get flooded or hit by a forest fire or drought or whatever. I mean, that's a medium-term risk. Your bigger risk in the shorter term is that you're going to get someone suing the company you may have invested in, or possibly equally. I don't think managers, for example, have thought much about this, nor by the way many investors. If you sit there and put out a bunch of targets and you don't meet them, you potentially are opening yourself up to litigation risk. And this is something that is actually happening right now. And a lot of managers and a lot of investors don't really think about that. So, when you talk about three-dimensional, I kind of think that it's much more than three. It's actually trying to bring this into your, what should be ideally a holistic viewpoint. A challenge, I would say, most investors have is that the one truism of risk management is that we never manage risks very well. Okay, this is why we have financial crises, this is why we keep firing risk managers and hiring new ones, and so on and so forth, right? And the reason why you have that is because there is a fundamental problem in most organizations, which is risk is a multidimensional surface. Unfortunately, you normally silo people into different buckets. So your ESG person is sitting in a different silo very often to your market risk person sitting to your credit committee and so on. So, there is an organizational point here as well, which I think is very important. It makes it another complexity, but it's one that I think people have to really think about how they integrate. And most institutions, in my experience, I would be bluntly honest, do not integrate it very well at the moment.
I'm sure that's true, but before we go on to the others, and this is what we're about to explore, perhaps in a little bit more detail, is how on earth, given we're going to get onto the collecting of emissions data in a second, how on earth can you calculate it then? Because there is, what do you or can you go on? That's what I don't really understand.
Look, I think, well, there are a few things. One is you have to identify which risks you care about, right? And climate risk, as I said, is a very, very big bucket. What do you actually care about within climate risk? Is it, what's your exposure? Is it farmland? Is it infrastructure? Is it power plants? Is it property? Where does it sit, etc., right? So break it down first into what you actually care about. That then allows you to figure out what is the relevant data that you care about, which then allows you to understand what the risk is. Risk is not really a science anyway, it's more of an art. And the one thing I would point out is that risk is a subset of uncertainty. Risk is that bit of uncertainty which we've tried to pin down with some kind of vague numbers. But the reality is that all you need really is a measure of risk and a ballpark of risk that you think is reasonably reliable. You have to be skeptical of it, you have to challenge it, you have to question it, you have to constantly refine it. But having a ballpark is infinitely better than just looking out into the infinite space and wondering where the hell you exactly are, right? So there's a process of iteration here. I think when you look at data that comes in, there is a real risk that people, because they're under pressure from, say, stakeholders up above, telling them they're ready to get onto this, ESG risk thing, and regulators and so on, because they've got pressure from below, they all start to quickly run around, grabbing every metric off the table and putting it on their portfolio. And you will end up with some very, very beautiful, I've seen some very beautiful ESG risk presentations that, give you 60 pages of lots of data. Good luck reading it. What you actually fundamentally want is a dashboard. And that's what a lot of people still haven't really developed in the ESG space.
Well, that's a perfect segue into where I wanted to go. So, Krina, can I come to you and ask you what are the problems with collecting emissions data and how quickly can it get out of date?
Interesting question, Simon, and I see that one of the audience has also asked a very similar question in terms of the obstacles around acquiring emissions data. So, I mean, if you consider just Scope 1 emissions, which are typically easier to measure than Scope 2 or 3, companies still face considerable challenges in collecting and in interpreting emissions data. So first of all, as Bob referenced, getting data that is accurate. And as I said in my opening comments, industry and governments historically have relied on bottom-up estimates. And so the top-down direct emissions from satellites will increasingly help companies to provide more and better data to investors. Secondly, then getting consistency and completeness. When you think about many global companies having to report across thousands of different sites across the world, with many of those sites in markets that are less well regulated than other markets where the company also has sites. Thirdly, then in the application of the data, so for whom or what is the data destined? So when you consider the volume of different regulations, standards, different requirements, there are many, many differences as to how data is prepared for the regulator, for lenders, insurers, for ratings agencies, and of course also for investors. Fourth, then, granularity and frequency. So, I mean, companies are often very hesitant to provide data at a granular level or on a frequent basis. So maybe they don't have the resources to collect and measure emissions from every site more frequently than once a year. Perhaps there's a fear of oversharing when their competitors are holding back. Whatever the justification, increased regulation and growing pressure from investors means that companies will have to address how frequently they provide emissions data. And more than that, to provide data that enables investors to better assess climate and financial risk. And if you add into that then Scope 3 emissions, as TCFD has highlighted, companies still face significant issues with collecting relevant and granular data, with differing supplier collection methodologies, with boundary challenges in terms of the company's involvement at multiple points in the life cycle of products, which can result in double counting of emissions. And of course, the challenges that come with actually having the resources to collect, manage, to quality control, and then to interpret supplier data. And I mean, in terms of the data being out of date, it's not unusual to find smaller funds, for example, using emissions data that can be as much as 2 years old. And I think that this is really where satellite technology can really make an impact, and why we're investing our resources into developing company level emissions data. So we're aggregating the granular data of our aircraft and satellites with the big picture view of public satellites to offer quarterly industry-wide data sets for emissions validation, for benchmarking, and of course for risk management.
I'm fascinated to hear you say 2 years old and be up to 2 years old, which seems from an outsider's point of view completely mad. Patricia, can I come to you and then Marika for your comments on the data challenges that have just been touched upon by Bob and Karina?
Yeah.
Do you come across data that's 2 years old in terms of what you do as well?
Yeah, definitely. And I would also love to share some figures and some numbers on some of the challenges that Karina mentioned to kind of put a little bit more color. So I guess let's talk first about coverage. Maybe Karina has not talked too much about that. So the first problem we face is we don't have all the data we would love to have. Even if we were using data reported by companies, not all companies are reporting greenhouse emissions. So for example, we look into a universe of 30,000 companies, and we look at the SFDR framework, the principal adverse impact indicators, just as a kind of a way to test it. No, those are 14 mandatory indicators, metrics that they need to disclose on. And actually, we found that only 3% of the universe were disclosing more than 70% of the data on those 14. So kind of the level of disclosure is small overall.
Sorry, only 3%? Did I hear you say
more than 70% were disclosing at least 70% of what was required, at least like 10 of those 14 indicators.
Right.
So overall, if like you look across themes, across metrics, like we are still like very far from like having like a broad comprehensive picture. Greenhouse emissions tends to be one of the metrics that companies disclose the most. But even there, like unpublicly listed companies disclose more than private companies, as Marieki very well knows. But even there, like we are talking about 6,000, 7,000 companies that are disclosing this metric. And more than 40% of those companies are not disclosing Scope 3. Karina was talking about the Scope 1, direct emissions, Scope 2, electricity related emissions, Scope 3, everything else, indirect emissions in the value chain. So more than 40% of the companies disclosing greenhouse emissions are not disclosing Scope 3. So then we go to quality. So like how reliable is this data? And Karina was mentioning Scope 1 is still challenges. We know like Scope 3 is like huge challenges. From those companies that are disclosing, I was saying 40% are not disclosing, then we have 60% disclosing. From that, 40% are saying, well, we know we are missing at least one relevant category because it's hard. It's like many different pieces that you need to put together to build the full picture of your Scope 3. And when I'm saying this, I'm talking about oil and gas companies that are not reporting the emissions related to the use of the products they sold, which is happens to be the largest category for oil and gas companies. So, I mean, the issue in terms of completeness, reliability is very important. So I think we should keep that in mind. And then finally on data challenges, I think the third piece that I mentioned at the beginning is transparency. We really need to understand what we are using. Is this reported? Is this estimated? There are a lot of estimated data. We do use machine learning techniques to provide estimates, but actually what we do is to also quantify the confidence level of the estimates, of the estimation models. And we will disclose that. We will provide that information to our clients. Is this a low confidence model, medium, or high confidence? Not all estimation models are the same. Understanding how the models are built, how the models are validating. Are we using reported data that the model has never seen to validate that model? That's very important. And then have you quantify the confidence? So all these pieces are important. Coverage is an issue. Estimation models can help filling in the gaps, but then we need to also look into the quality and the transparency. Do we have all the information? Do we understand what we are using?
Thank you. And Marika, A, do you agree with what Patricia was just saying? And B, how do you think emissions data can improve decision-making at company and investor level?
Yeah, so I think, Patricia, I think there's a specific question on your percentages. Maybe let's answer that somewhere in the next couple of minutes to maybe make people understand what the percentages exactly mean. So yeah, so you know, we're talking about data gaps and you know, we actually talk to these companies, and you know what is happening with firms that, for instance, are invested by private equity firms. they get invested, and then they are part of a buy and build strategy. So that means, they might have 2 locations. Now, next year, they have 20 locations. They buy all of these smaller companies. And then next year, all of these smaller companies that are now part of this larger holding are supposed to provide energy-specific data to their holding. And that is one of the challenges that we face. Is we talk to these specific smaller companies, and they might not even have their financial data, ready. And we support them in identifying which utility bills do you need to look into to actually get us the data that we need to estimate your carbon footprint. So those are the challenges that are not that uncommon, especially in private equity. If you have a buy and build strategy, and there's all of these larger or all of these smaller locations that just really need hand-holding to understand, what do you need from me, and then how are you going to use it, and then if you can calculate my carbon footprint, what can I do next? So great that I have these insights. What's next? So what? Another example here is, for instance, our own carbon emissions are quite difficult to account for, also because we are we have a couple of our own offices. We rent them, but it's quite easy to get energy data from that. But we are also part of, for instance, very large office buildings like I am in New York City. And then there's no way for me to get the energy data of this building. It will be my main impact, beside my scope 3 emissions. It will be my main impact, the energy use of the building. But there's no way for me to get that data. So I'm kind of estimating based on, square meters. And it's just, and those are the type of challenges that are here. So, we can talk about data gaps and the fact that companies are not, providing that, but there's actual challenges and they need some hand-holding there. And I think that that's what we underestimate here. I think there's not that much reluctance, although you might expect that if you receive an empty data request. But there's just some support required there.
Okay,
yeah.
Sorry.
No, maybe I wanted to also hand back to Patricia, because I'm curious about your insights there as well.
Do you want to answer that, Patricia? Somebody actually asked quickly, because I got couple of questions and time is really galloping on. Somebody did ask Patricia, so one of the questions that have come in, can we clarify the percentage Patricia mentioned? So do you want to quickly answer that, and then we'll move on?
So I talk about 2 things. Let's focus on greenhouse emissions. So from the companies reporting greenhouse emissions, like more than 40%, between 40 and 50%, are not reporting scope 3. So only like half, let's say, to round up, about half are reporting scope 3. And from that half that are reporting scope 3, 40% recognize that actually they are missing, they are not reporting, they haven't been able, because of some of the challenges that Marieke was mentioning, it is not easy, they have not yet been able to model and estimate one relevant category for their disclosure. So all this to illustrate that coverage completeness is a real issue when we talk about this data.
Thank you. Okay, let's move on. And time is galloping away. We've only got 15 minutes left, and I'm conscious we have now 8 questions that have come in, and we'll attempt to tackle most of those in a minute. Well, can I come to you? I mean, thoughts just 2 slightly different points I'm going to make to you, which is, and then I'm going to come to Karina, is what is emissions data mainly used for by investors? Performance, risk analysis, validation, what are the main reasons? But as well as asking you that, the thoughts, as Patricia was just talking there, the thoughts just occur to me, we're talking about $1 trillion, multi-trillion-dollar industry. And this is a point you make about dodgy data. It's just not relying upon, and the lack of reporting that Patricia and Marika have just been talking about, and the difficulty in getting the figures right, is I didn't quite realize how bad it actually is. How on earth can you, how can investors ascertain, how can they calculate this? In a sense, I've already asked this question earlier, but I'm asking you again in a slightly different context. And to repeat, the other part of the question is, what are they using it for? Performance, risk analysis, and so on.
Well, Simon, like I said, it's a bit like the Wild West, right? You know, plenty of snake oil salesmen out there. You know, the one thing I will note is that if you look at your questions, you've got a whole range of them there. You know, what you'll find when you talk to people about climate change and even ESG more broadly is you just get lots and lots of questions and very few answers. The big gap in that whole universe is actually strategy, right? This is why I keep talking about the need to know what you want to do with this stuff. I can tell you that when I look at, you know, everything from private equity firms to, you know, asset managers to insurance companies to pension plans to endowments and so on, you know, I mean, a lot of my role is, you know, we tend to advise people a lot on ESG type stuff around strategy, and we tend to do a lot of stuff where we sit on investment committees or boards or things like that. And strategy probably is the single biggest challenge for most people, because it's that ability to take all this noise, and there's a hell of a lot of noise out there, and filter it down to something that you can actually action, which is going to be helpful to you. Because the big risk here for most people is that fundamentally, no matter what we all say, no one is really doing this for completely altruistic reasons, okay? Everyone's a pragmatist. The investor's doing it because they believe it will secure them a better long-term return. The insurer is doing it because they want to get the claims losses down, okay? The asset manager is doing it because everybody else seems to be buying it, right? I mean, at the end of the day, it's going to come down to people saying, what's my return on investment? And if they spend a lot of money and find that it doesn't translate into either more business development, more income, better returns, etc., there's a real danger you end up back as what used to happen, if you remember, back in the responsible investing kind of bubble that blew up in the sort of 90s and early 2000s, where a lot of people piled into sort of lots of funds that were going to be all about responsible investing. But when they came down with the fact that actually somehow they were not getting the returns they were after, or that the monies weren't flowing to asset managers, it started to unwind. Investors don't know what to do with the data, okay? There is this kind of kitchen sink approach right now where you just ask for everything and then you see what you can do with it. You know, what do you do with this data, okay? What are you going to do with emissions data? I mean, frankly speaking, there's a lot of hot air at the moment. What are you going to actually do with it? What is it going to tell you about your portfolio? Unless you can translate that into tangible outcomes, it's just another macro thread you've overlaid in your portfolio, like inflation or whatever. It's great. You can spend ages talking about inflation and rates and whatever. It doesn't really matter. What matters is what it means for the assets in your portfolio, for the companies that you run, and how that goes ahead. Most investors are taking the approach that TCFD has given them a bunch of things they need to do, but they're very broad brushstrokes. They're grabbing a lot of data. You start to get some people, particularly on the manager side, trying to discriminate a little bit because they've suddenly realized they can't pay for everything. So you need to figure out what's actually worth paying for. But no one's really decided yet what the utility of all of this is and how it translates into their actions. So you know, my simple answer to you is that we're all heading out west. We're still trying to find, you know, that kind of promised land, as it were.
Yes, well, there's a huge amount of dollars or pounds or euros looking for a solution here. And what I'm getting out of this discussion, which is a bit depressing in a way, is we've got an awful long way to go, which actually brings me to Karina. Then we'll go to questions after this. Can I put this to you, Karina? What does your emissions data that GHGSat is producing, what is it used for in the industry so far as well? It's sort of the same question as I was asking Bob in a different way.
Indeed, yeah. So, I mean, I think if you think about the evolution of ESG, particularly over the last couple of years, certainly what we're starting to see is the separation of those three pillars and increasing focus on the E and indeed on emissions as a potential yardstick for company performance. And we see this being used, I probably most strongly with hedge funds and with the asset managers that have extensive in-house analytics capability and who are looking for not just company level data, but asset and facility level data for advanced modeling and for the efficient allocation of capital. Outside of that very small segment of the industry, the biggest demand, certainly for our data right now, is for validation, to help managers and investors and insurers to really understand the emissions profile of the companies that they are investing in and insuring and lending to. Now, I mean, that will change, that will evolve over time, but certainly right now, validation, governance, understanding a little bit more in terms of setting metrics and targets, but really very much validation.
What happens, very quickly, out of curiosity, I'm fascinated to know the answer to this question. They're using it for validation, and they're not, the figures they're getting from you aren't validating the figures they were having before. And how often does that happen?
Yeah, so that's an interesting question. So we are going live in February of next year with our company level emissions data. And so we've produced an early version of that data set. So top 10 oil and gas companies, US emissions. And by and large, our data is not significantly different to the disclosed emissions of those oil and gas companies for their assets that are in the US. Now, that's not a huge surprise. When you think about the US, it's a reasonably well-regulated market. But if you think about developing and emerging markets where those companies will also have assets, then we certainly expect to see greater disparity between estimated emissions and the observed emissions that come from satellites.
All right, excellent, thank you. Now we've got only 8 minutes left. I'm going to try and pick out questions from the audience that I'm going to be sort of a bit dictatorial about this, that I think are the most interesting. So we'll try and do our best to cover as many of them as possible. I'm going to one at the very bottom here. How are you translating emissions data points, for example, scope 1 methane emissions, into risk figures? Is risk thought of as a potential cost scenario, e.g. losing license to operate for an asset, which I think is a really interesting question for somebody. Who wants to tackle that? And no? Anyone want to have a go at that one?
I'm not sure you're going to get any takers for that.
Go on, Bob, you're going to have a go at that.
That's okay. I love the sound of my voice anyway, so it's perfect. You know, I think this was the question we had just before, which is what do you do with all this data, right? I mean, this is the exact problem, which is, okay, you got this data. What are you going to do with that? What risk does this actually mean? And this comes down to the purpose of it, which is, are you going to run some scenarios? Do you have some views on what, for example, rising emissions might do to, you know, profitability or business lines, or kind of actual, kind of environmental impacts and areas of investment? These are things that people just haven't thought of. I mean, I'm amazed that somebody actually talked about the potential cost scenario, losing a license to operate an asset. I mean, that business risk operation was what I was talking about at the very start, which is that's the bit that people actually haven't really considered. Most of them still think in very simplistic investment terms, which is, the market value of my asset will go down in some form or the other. They haven't necessarily thought about the regulatory risk, the litigation risk, etc. So the simple answer is, how are you translating? I don't know. Pick a number, pick a random phrase. I mean, who knows? You can ask 100 different people and you're going to get 100 people shrugging their shoulders going, no, but I'm hoping you can tell me.
Here, another question, which is, I'm going for the slightly broader ones, if you don't mind. What is the main obstacle to acquire data and integrate data into the investment process? I mean, in a sense, that's what we've been talking about all afternoon long, but if you want to sum up the main obstacles, anybody? Particularly Patricia and Marika, you'd probably be very good at this. Patricia, what are the main obstacles, do you think? Just the quality of the stuff, the reporting, I guess. Would you say that, or?
Yeah, definitely. So I do think that the quality that we were talking about, and the availability, the reliability, and the coverage of the data, having the data you need. We were mentioning emerging market and even more challenging private markets. Then covering, I think there was also a question there. Also, portfolios have different type of assets, so coverage across different type of assets. We haven't touched on that one, but that's definitely also a big challenge.
Okay. I'm gonna, this next question is probably I'm gonna give to you, Marika, if I may, which is the question about regulation. I know that's an area that you guys focus on, which is, do you think the upcoming EU and UK regulation of ESG data providers will improve the quality of data?
Yeah. So these we're talking about rating agencies, and to be honest, we are kind of the private market version of that. So I'm not too experienced with these rating agencies' upcoming regulation. I definitely think it should be regulated because you see the correlation between different rating agencies is very low. You know, we all have seen, I think, the charts where the different companies are in ESG ratings are compared, and I think correlation was about 50%. So that's you know, not something that I feel like is super usable at the moment. But maybe more broadly, I think, as far as I can see, at least with our clients, is that both SDR as well as SFDR regulations, so that's UK and EU, I think that's definitely putting a lot of pressure, making people feel anxious about gathering the right information. And I think that's a good thing. And I think that is going to improve the quality. So that's at least my private market perspective. But in general, we see that the regulation is pushing, especially Europe, significantly in taking this seriously. And to be honest, just moving to the US, of course, I also expect that that's going to be the same thing in the US. And you know, I think as Bob already referenced to, this is not going to be that voluntary, and we are not. I don't expect us to do this just because we think it's the right thing to do. Well, we might, but I think in the world might not. So I think the regulation is going to help us a lot there. Yeah.
And Simon, can I just add to that? Obviously, I agree with Marika in terms of you know, the increased regulation of ESG data providers is a good thing and will, I think, make some improvements. But you know, I think what that regulation looks like and what it requires the data providers to do is something that that needs to be very carefully considered. You know, because you've got two things. You've got the methodology by which they collect their data and providing transparency around that methodology. But just as important, you've got the data itself and the validation through a third party, for example, of the data that the agencies are presenting. So validation being equally as important as the methodology that's used to get the data.
Yeah, but I think that regulation is mostly about conflict of interest and transparency, and I definitely think that will help, and it's something that we very much welcome.
Well, thank you all very much indeed, those of you around the world who have been following this, and to Karina, to Marika, to Patricia, and to Bob for their contributions. I apologize profusely for the failure of my presentation. Luckily, it was only a very short presentation to materialize. The only good news is that I was taking that from a white paper we did back in the late spring on this particular topic, and we will send that to you all, so you'll get it in glorious Technicolor with lots of graphs and in much more detail anyway, so there is no escape. In other words, we will very much send that to you. The other thing which I did very briefly touch upon, I want to emphasize now, if I may, we're in the midst of doing what I think is an absolutely fascinating research study with portfolio managers primarily on how they are integrating some of the things, or a lot of the things we've been talking about here today, into their portfolios. Portfolio managers following this discussion today, or investors in some way or another, we would love to interview you guys as well. A colleague of mine called Samantha Taylor will be in touch about that shortly. We'd love to include your views in that. I think I'm right in saying it's the first time proper independent research has been done with portfolio managers and investors on the integration of how they are going about doing, incorporating the topics that we've been talking about into their investment decisions. So we're really looking forward to doing that. We're getting some of the results in already, and we will hopefully be getting an awful lot more in the coming weeks. So again, thank you all. Those of you in the States, have a good lunch and afternoon and evening. Those of you in Europe, have a very good evening. Thank you very much for joining us today, and hopefully see you the next time. Bye-bye, everybody.
Thank you.
Thanks, everyone.
Bye.
Thanks a lot. Bye.